Did you know silver surged to $84 overnight, only to crash back down by 20% in just a few hours? In the same breath, gold is slipping, stocks are wobbling, and investors everywhere are asking, is this the start of something bigger? All right, while social media screams about silver hitting $300 and Bitcoin going to the moon, seasoned traders are quietly stepping aside. Why? Because when hype peaks, danger begins. In today's video, we're breaking down 10 powerful technical reasons why this sudden silver collapse and the broader market action could be the early warning sign of a major correction in January. These aren't just guesses. They're based on chart patterns, psychological traps, and smart money signals that too many retail investors miss until it's too late. So before you buy another shiny metal or chase the next breakout, stick with us. This breakdown might just save your portfolio from getting crushed in the coming weeks. Number one, when everyone turns bullish, the market is already in trouble. One of the most dangerous moments for any investor is not when prices are falling. It's when everyone is suddenly convinced prices can only go up. This is exactly what we just witnessed in silver. In a matter of days, silver didn't just rise, it went vertical. Prices exploded upward, social media lit up, and bold claims like $200 silver and $300 silver started spreading everywhere. And here's the uncomfortable truth most people don't want to hear. That level of excitement is rarely the beginning. It's usually the end. Markets don't top quietly. They top when confidence turns into arrogance and optimism turns into blind belief. When you see nonstop hype, aggressive price targets, and influencers acting like profits are guaranteed, that's not strength. That's emotional overheating. At that point, the smart money isn't buying. The smart money is selling into the excitement, using that hype as exit liquidity while late buyers rush in, afraid of missing out. This pattern has repeated itself again and again. Bitcoin in 2021, AI stocks at their peak, meme stocks before their collapse. Every time the story was different, but the psychology was the same. People didn't buy because of value or logic. They bought because everyone else was buying. And markets punish that behavior without mercy. This is why technical traders become cautious when price moves turn parabolic. Parabolic moves feel exciting, but they're unstable. They stretch price too far, too fast, and leave no solid support underneath. Once momentum slows, even slightly, the fall can be violent and sudden. So if you ever catch yourself thinking, everyone is bullish, I need to get in now, stop. That feeling isn't opportunity. It's usually a warning sign. Number two, parabolic charts. Always snap back, harder than you expect. When a price chart goes straight up, it might feel like a dream, but it's often the start of a nightmare. That's exactly what happened with silver's explosive move to $84. It didn't climb steadily or gradually. It rocketed up in a short burst, driven by hype, fear of missing out, and viral narratives. But here's the thing about parabolic moves. They don't last. In fact, they almost always end in violent reversals, just like this one did. Why? Because markets need structure to be healthy. When price flies upward too quickly, it skips over key support levels, the safety nets that allow a market to correct gradually. Without those, there's nothing to catch it on the way down. So when the first wave of sellers shows up, maybe it's an institution, maybe it's a few big traders locking in profits, the entire structure crumbles. What looks like a minor dip quickly turns into a free fall. That's what we're seeing now. From $84 to the mid-60s in a single session, that's more than a 20% drop overnight. And yet, people are still asking, is it time to buy? The answer is, not yet. Not until the chart builds a new base, shows signs of real support, and resets for a healthier move. Jumping in during a parabolic collapse is like trying to catch a knife while it's falling. You might grab it, but you'll probably get cut. History has shown this pattern again and again. Bitcoin, Nvidia, Tesla, GameStop. Any asset that goes parabolic eventually snaps back. That's not opinion. That's math and human behavior at work. So if a chart looks too good to be true, take a step back. Because what goes up without reason comes down with force. Number three, influencer narratives often mark the exit, not the entry. You've seen the headlines. You've heard the predictions. Silver is going to $300. China is cutting supply. Buy now before it's too late. Sounds exciting, right? But here's the cold truth. Most retail investors don't realize when the loudest voices on social media start pumping a story, it's usually because the smart money is already heading for the exits. Big institutional players don't announce their moves. They buy quietly when no one's paying attention, and they sell during the hype when the crowd rushes in. So when you see a sudden surge of bullish headlines, emotional tweets, and viral videos hyping one asset, it's time to pause and ask, who benefits from this? Because the answer is almost always, not you. This isn't just theory. Over the weekend, silver was all over social platforms. Influencers were claiming the price would explode because of a massive supply shortage, largely tied to China. But guess what? The price reversed hard Monday morning. That's not a coincidence, that's a pattern. And if you fell for it, you weren't buying the breakout, you were providing liquidity for someone else to get out. This is how exit liquidity works. A bullish story creates demand. The demand pushes prices higher, and those already holding massive positions use that enthusiasm to quietly unload. It's not illegal. It's just how markets work when emotions take over and logic steps aside. So the next time someone online tells you an asset is about to go to the moon, don't just ask, how high? Ask, why now? And better yet, look at the chart. If it shows a parabolic move, overbought conditions, or major resistance levels, you might be staring at a trap dressed up as opportunity. Number 4, emotional buying is the fastest way to lose money. Let's face it, most investors don't make decisions based on logic. They make decisions based on feelings, and that's exactly what the market counts on. The moment silver started skyrocketing, a flood of emotional buyers rushed in, not because they had studied the charts, not because they understood the fundamentals, but because they were afraid of missing out. That fear? It's the same trap that has wiped out portfolios again and again. Think about it. Did you feel the urge to buy silver when it was sitting at $20? Probably not. It wasn't exciting. But once it hit $79, everyone wanted in. Why? Because price movement triggers emotion. You see something rising fast, and your brain screams, if I don't buy now, I'll miss it. But here's the hard truth. Emotion is the enemy of smart investing. Emotional buying often happens at the worst possible time, right at the top. And emotional selling, right at the bottom. It creates a cycle where retail investors buy high and sell low, while professionals do the exact opposite. That's why technical traders train themselves to stay calm, wait for confirmations, and ignore the noise. They don't chase. They let the market come to them. Silver's recent spike wasn't about solid fundamentals or long-term demand. It was about emotion, excitement, and headlines. And now that the emotional rush has faded, reality is kicking in hard. The price is falling, and the same people who bought with excitement are now panicking with regret. So here's the lesson. If you feel emotionally charged when making a trade, whether it's greed, fear, or hype, that's your signal to pause. Step back. Breathe. Because the most profitable trades aren't driven by emotion. They're driven by patience, logic, and discipline. Number 5, blow off. Tops are easy to miss until it's too late. Most people only realize a market has topped after the damage is done. That's the sneaky nature of a blow-off top. It looks like a breakout, feels like momentum, and pulls in even the most cautious traders. Silver's recent move is a textbook example. After a slow buildup, it exploded upwards to nearly $84 overnight, triggering massive excitement. But just hours later, that excitement turned into panic as silver plummeted back to the mid-60s. That's not normal volatility, that's a blow-off top. So what exactly is a blow-off top? It's when price goes vertical, too fast, too soon, usually fueled by emotion, hype, and speculative buying. There's no steady consolidation or support building underneath, just pure upward momentum. And when it runs out, the fall is just as aggressive as the rise, often worse. The problem is, most traders mistake it for a healthy breakout and buy in at the very peak. Blow-off tops are usually confirmed after the fact, which is why they're so dangerous. But there are warning signs. Emotional headlines, massive social media buzz. Unrealistic price targets, and vertical price movement on high volume followed by a sudden reversal. All of these were present in silver's recent surge. Now here's where it gets risky. Many people who missed the move up start buying during the initial dip, thinking they're getting a discount. But in reality, they're buying a falling knife. The correction hasn't finished. It's just starting. Without technical support, price can spiral down quickly. The key takeaway? Don't confuse speed with strength. A strong chart builds solid bases and moves with structure. A blow-off top is a warning flare, a signal that the party is over. And unless you're shorting the top, you don't want to be the last one in before the crash. Number 6, light volume rallies are built on weak foundations. One of the most overlooked dangers in any rally is low trading volume. When prices rise on light volume, especially during holiday weeks or weekends, it may look impressive on the surface, but underneath, the structure is incredibly fragile. That's exactly what we saw with silver's recent surge. The rally to $84 happened during one of the lightest trading periods of the year, when institutional players were mostly out of the market and retail enthusiasm was unchecked. Here's why that matters. Volume confirms conviction. If price is moving up and the volume is strong, it tells you that big money is behind the move. But if the price is spiking and the volume is thin, it's usually retail investors chasing momentum, while smart money waits in the shadows. Without institutional support, the rally becomes unstable. and it only takes a small wave of selling to trigger a major crash. That's what makes holiday breakouts so dangerous. They create the illusion of strength, but it's often just smoke and mirrors. Traders and investors who buy into these thin volume breakouts are essentially building a house on sand. The moment real volume returns, usually on a Monday or after a holiday, reality hits, and the price collapses under its own weight. Silver's dramatic reversal right after the weekend is no coincidence. It was a trap, set by light volume and fueled by emotional buying. When the market opened with real volume, it quickly exposed the weakness of the move, and sellers took full control. So, the next time you see a chart flying upward during a low volume period, don't get excited, get skeptical. Ask yourself, who's really buying right now? Because if the answer is mostly retail traders and momentum chasers, the smart move might be to wait, or even prepare to go the other way. Number 7, history repeats, especially in the markets. There's a reason the phrase history repeats itself is so popular in trading, because it does, time and time again. Markets may evolve, technologies may change, but the psychology of investors remains the same. What we just witnessed with silver mirrors, identical patterns from Bitcoin in 2021, meme stocks in 2020, and AI stocks in 2023. The players may be different, but the game is always the same. Parabolic rise, media hype, emotional buying, followed by a brutal correction. Look back at Bitcoin in 2021. As the price pushed towards $69,000, influencers flooded social media with predictions of $250,000 or more. Institutions quietly took profits while retail piled in at the top. Within months, the price collapsed. Now, compare that to silver's recent move. Massive hype, wild price targets, emotional headlines, and a sharp reversal right after the frenzy peaked. It's the same playbook, just a different asset. This repeating cycle isn't just coincidence, it's human nature. People are hardwired to follow the crowd, chase what's hot, and avoid what's boring. That's why smart investors use historical charts and price patterns as a roadmap. Because what worked or failed in the past can often predict what's coming next. Even technical analysis is built on this idea. Patterns like double tops, head and shoulders, and ascending wedges exist because human behavior is predictable when money is on the line. The excitement, the fear, the greed, it all shows up on the charts in familiar ways. So if you're wondering where silver, gold, or even the broader market is headed, don't just guess. Study history, look at the charts, recognize the emotional cycles. Because the best investors aren't just students of finance, they're students of the past. And those who learn from it, they usually come out way ahead. Number 8, weak hands fuel big drops. When a market is flooded with weak hands, it becomes a ticking time bomb. Weak hands are investors who buy with emotion, lack conviction, and panic at the first sign of red. They chase trends, buy late, and often don't understand what they're holding. When silver exploded to $84 overnight, it wasn't just long-term holders pushing the price. It was a flood of short-term speculators jumping in for a quick win. But what happens when those same traders see the price drop? They rush for the exits, all at once. This kind of panicked selling is what leads to sharp, aggressive reversals, just like we saw in silver's collapse back to the mid-60s. Unlike seasoned investors, weak hands don't ride out corrections. They sell emotionally. And when too many of them try to exit at the same time, it creates a cascade of selling that crushes the price far below fair value. On the other hand, strong hands, the institutional players, long-term holders, and disciplined traders, don't chase price. They buy when everyone else is scared, and they hold when everyone else is panicking. These are the players who move the market, but they rarely act during the hype. Instead, they wait patiently for better entries, often after weak hands have already been shaken out. That's why smart traders don't just look at price action. They ask, who's buying right now? If the move is driven by emotion, hype, and low-conviction retail buyers, it's a warning sign. Because when the tide turns, those weak hands won't stick around. They'll exit fast, adding fuel to the fire. So before you jump into a hot market, take a step back. Are you buying with confidence or just reacting to the crowd? Because in volatile markets, weak hands get wrecked and only the strong survive. Number 9, major resistance zones are where rallies go to die. Every chart tells a story, and some chapters are harder to break through than others. When an asset approaches a major resistance zone, it's like hitting a brick wall. Unless there's overwhelming momentum backed by volume and strong fundamentals, that wall usually holds the price back and often causes it to reverse. That's exactly what we're starting to see in the broader market, especially with the S&P 500. Right now, the S&P is brushing up against a multi-month resistance level, one that's acted as a ceiling before. And just like in silver, the closer price gets to that ceiling, the more cautious smart traders become. Why? Because it's not just a line on a chart. It's a zone filled with sellers waiting to take profits, hedge funds looking to rebalance, and algorithms ready to trigger reversals. It's where rallies lose steam, and often where corrections begin. The problem is, retail investors rarely recognize resistance. They see green candles and assume it'll just keep going. But price doesn't move in straight lines. When a chart runs into strong resistance without taking a breather, it's like trying to sprint through a brick wall. It's unrealistic, and more often than not, the market pushes back hard. What's more alarming is that January corrections are historically common. Institutional traders return from the holidays, rebalance portfolios, and start preparing for the year ahead. If the S&P can't break through resistance cleanly, we could see a broad market pullback, and it may happen faster than people expect. So here's the move. Don't get greedy at resistance. Watch the chart, wait for confirmation of a breakout. Not just a spike, and if the price starts to stall near that level, consider it a warning. Because more often than not, major resistance is where the rally ends, and the fall begins. Number 10, the smart money waits for the pullback. You should too. The best traders in the world have one trait in common: patience. While the crowd chases hype, jumps into overheated markets, and buys breakouts at the top, the smart money does something different. They wait for the pullback. They know that every parabolic move, no matter how exciting, eventually needs to breathe. And when it does, that's when they strike. Right now, in silver, gold, and even the broader stock market, we're seeing signs of exhaustion. The hype has played out. Volume is returning. And the charts are showing signs of reversal. But here's where the opportunity comes in. Not during the chaos, but after the dust settles. The correction, as painful as it may feel, is where the smart money finds value. They're not looking for highs. They're looking for discounts backed by strong technical setups. Look at Gareth Soloway's strategy. He didn't buy silver at 84s. He waited. He's now watching key support zones in the $50, $51 range before even thinking about entering. Why? Because that's where the risk-reward finally makes sense. Buying after a crash, when everyone else is scared, is where real wealth is built, not during the hype. This approach applies to all markets, to crypto, commodities, stocks. Jumping in during euphoria puts you at the mercy of weak hands and emotional swings. But waiting for structure, confirmation, and support, that's how you trade like a professional. So the final and most important lesson is this: there's no rush. Let the market come to you. Let the emotional traders burn themselves out. And when prices finally pull back to levels that make technical sense, that's when you move. Because in trading, the ones who wait for the right pitch are usually the ones who hit it out of the park.